Welcome to Dental Business RX. Practice success in 30 minutes or less.
Thank you for calling ABC Dental.
If you own a practice, have you ever felt like you're working hard and the practice is generating a decent amount of revenue, but you have little or nothing to show for it at the end of the month or the end of the year? Or have you ever found that no matter how much you make, it seems like it all gets spent and you've saved little to nothing at all? Well, what's the solution? You may have tried, cutting costs, instituted budgets, watching every nickel. You can't say watching every penny anymore. There's no more pennies. And still nothing. Well, what's going wrong here? Well, to begin, there could be a lot of things going wrong. But in many cases, I'm not saying in every case, but in many cases, what I've found when working with clients on their finances is they run into these problems not because they're not making revenue, but they don't know a few basic laws of managing money, and specifically managing money in a group or company. When you get a bunch of people together into an organizational setup, the rules change. You may be good or bad at managing finance on a personal level, but when you're managing money in organization, a group, a company, etc., fundamental things change. And if you don't know these things, you won't ever have anything extra. And that's what I want to talk about in this week's episode. Some of the fundamentals of financial management in a group and how to create a surplus so that you do have something to show for all your hard work. My name is Jeff Bloomberg, and I'm your host. And I should start off by saying there is a ton to know about financial management. Obviously, I'm not going to cover everything in a half-hour podcast. That said, we are going to hit on some of the critical basics that can get you moving in the right direction. If you want more information on this, I could direct you to two places. One would be, this is one of my shameless plugs, our online platform, DDS Success. We have a 4-part financial course. I think parts 1 through 3 are published. Part 4 is currently wrapping up final editing, which walks you through all of this. I'll put a link to it on the episode webpage. We also have a seminar on the MGE Power Program as well as individualized one-on-one help. The seminar is called Financial Planning and Profitability. I'll put a link to the Power Program on the episode webpage as well. Anyway, so managing finances in a group of people, right? Let's say you've done your overhead sheet. You've got a practice, you have a business, you've done your overhead sheet. And if you haven't and you need one, I'll put a link to it on the episode webpage. It's a very thorough, complete overhead sheet for your practice. But let's say you've done this sheet and you have an idea of how much it costs to manage the business. Now, where do people normally take the first wrong step? Well, let's dig into some of these fundamentals to understand. Now, if you know about MGE, you know that we use the Hubbard management system developed by L. Ron Hubbard. It's an amazingly workable system. It consists of millions of words on every aspect of organization you could possibly imagine, sales, personnel, efficiency, management, and finance. And these basics I'm sharing with you this week come from Mr. Hubbard's works on finance. So what's our first fundamental here? What does Mr. Hubbard say? This is the first fundamental. It's one of the first things I learned about managing finances in a company. Here's what it says. It's from an article called Financial Management. It says, an organization will try to spend more than it makes. I'll read that again. An organization will try to spend more than it makes. Now, this is one of these things, and this is what I tell people when I go over this in seminar format. You could go, okay, cool, that sounds great. I'm going to still do whatever I'm doing. And they always find out this to be true. You could, there's just a funny thing that happens when you put a group of people together. This is what happens. The organization, as Mr. Hubbard says, will try to spend more than it makes. And here's an experiment that I would not recommend you do, but if you're really stubborn and insistent, you could try this. Have a staff meeting. Let's say your overhead is $80,000 and you did $100,000. So you have a $20,000 surplus. Have a staff meeting and ask everybody what you should do with this surplus. And these could be the best dental staff, the most angelic dental staff that ever walked the earth. What kind of answers do you think you're going to get? Are they going to be, oh, you should save that money, doctor? No, it's going to be, we need to do this, we need to do that, we need a new Cavitron, we should get a bonus, we should get a this, we should get a that, we need to buy into this, patients really want this. Everybody is going to spend all the money. It's just part of the nature of when you put a group of people together. I mean, if you want to look for any type of evidence, and I'm not taking we're an apolitical, irreligious, nonpartisan group, right? We're all about just improving conditions in your dental practice. But look at any government. A government always spends more than it makes. It's what happens. You put a committee of people together, they spend all the money. That's what happens. So, again, don't try that at home. I'm not recommending it at all. If you're real stubborn, you can, but that's the first thing to know. As Mr. Hubbard says again, an organization will try to spend more than it makes. Now, there's a couple other things he covers here. Next rule here. Economy. Like, what's economy? It's, saving on things, not wasting, right? Economy is aimed at preventing it from spending more than it makes. Okay, makes sense, right? We're trying to eliminate waste and keep people from wasting things so that we don't spend more than we make. He goes on. Next rule. An organization's expenditures are not regulated by what the organization needs in order to do business. There's more to this rule, but let's break this down or unpack this. Read it again. An organization's expenditures are not regulated by what the organization needs in order to do business. So the money you're spending on it, so let's say the amount of money that we're spending, you would think that that's related to how much we need to spend in order to continue in business. So what he's saying is not the case here. It's not regulated by what the organization needs in order to do business. And here's the second half of this. But by what an organization thinks it has available for expenditure. So what's regulating what we're spending is what we think we have to spend. So if the organization thinks it can spend $100,000 a month, that's what we have. Guess how much the organization's going to spend? $100,000. Or if you follow this first rule here, we're going to try, as Mr. Hubbard says, organization will try to spend more than it makes. We'll try to spend 105. This is just one of these rules when you're managing money. And then we have this next one. And this has to do with income. Income, which in your case would be collections, income is regulated by what an organization thinks it has to have to operate. Read that again. Income is regulated by what an organization thinks it has to have to operate. So if we were to transpose this into a practice, and here's the thing. You may not share your numbers with your team. You may not share your expenses with your team. You probably don't share your overhead or P&L with your team. I'm not telling you to do that, okay? That is not, it's actually the opposite of what I'm telling you to do. But if we have an idea that we need to make as an organization $80,000 a month, we'll make $80,000 a month in most cases unless something is horribly wrong in the business. Do you see? But that's generally the mentality that the organization will walk around with. That's what we're going for. We're going for 80. And you could actually, again, I'm going to give you an experiment. Like, please don't try this at home. But let's say you really want to do 150 to be at a good level financially, but you really only need 110 to operate. So you have a staff meeting. You tell everybody, hey, guys, I really want to do 150 because then I could retire debt, I could pay stuff off, I could get new equipment, we could do that marketing plan we've always wanted to do, I could give people bonuses, etc. Right? This is what you're telling everybody. You want to do 150. But it only costs $110,000 to run the business. So I'd like 150, that would be cool, but 110 pays the bills. How much are you going to make? Well, according to this, income is regulated by what an organization thinks it has to operate. You will make 110. And I've seen this happen again and again and again because this is what we feel like we have to make, so that's what we're going to make. And I can only tell you I've lived this so many times. This is so 100% accurate. I've just lived through it so many times. It's just how it works, okay? So now, I want to create a surplus, and I want to keep this surplus, my extra, my savings. However, I'm going to keep this surplus. How do I manage the organization and manage the organization finances to create a surplus? Well, obviously, it assumes in the first place that I'm productive and that costs are not completely out of control. Someone's watching the store. We're managing our finances, right? If I'm not, and we're just not, let's say my overhead is $80,000 and I'm making $60,000 a month, I'm going to have nowhere near a surplus. I need to handle the productivity of my practice. Now, why is that production low? Look, I mean, there could be a million different reasons. Some of the biggest culprits usually are poor case acceptance, which, we have things like the MGE communication and sales seminars you can check out. I'll put a link to it on the episode webpage. You gotta watch it with the links here. You might have some non-productive staff. You might have a toxic staff member. There could be any number of reasons. There could be lack of direction. There's stuff going on. If the place is just not viable, we're making $20,000 less than we need in order to pay our bills. We're going out of business, right? But most offices aren't that bad off. Let's say we're just not doing great. We're not saving anything. We're somewhat productive, but it's not going as well as we'd like it to be, right? Well, let's say that's happening and I still have nothing to show for it. There are some basic rules on how to create this surplus. There's those rules on money management I just read to you, right, on how the organization thinks. But now I want to create a surplus. So what are these rules Mr. Hubbard lays out? Let me read these to you. So he's talking about a surplus now. He says this. A surplus is achieved only by making it part of what an organization spends. A surplus is achieved only by making it part of what an organization spends. Now, how would we literally apply that? Think about this for a second. So if the messaging I'm giving the team, for bonuses or for raises and, our monthly goal is that our goal every month is to do 100 and my overhead is 100, right? That's what I need to do 100, but my overhead's actually 100. Well, then we go back to that last rule I read you before about income is regulated by what an organization thinks it has to have to operate. We're going to make 100 and I'm going to have no surplus. But now if I'm going to apply this, I'm going to achieve a surplus by only making it part of what the organization spends. So then as far as in my mind, the way I'm kind of crafting this is if my overhead's 100, well, to incorporate that surplus into my expenses, as far as everybody's concerned, our goal is 120. That's what we need to make. Do you see? I've baked that surplus into my overhead as far as messaging to the group. This is what we need to make. He adds to this a bit here. He goes on. He says, financial management cannot achieve a financial surplus by economy alone. Because you'll see a lot of people do this. They'll try to save themselves into solvency. They'll cut expenses, or they'll stop doing that marketing plan, or they'll, not pay for something thinking that's going to solve all their problems. And, the funny thing is you're usually better off looking at your income rather than expenses. Again, I'm not saying to waste money or spend money that you shouldn't be spending. But in most cases, the amount you're actually going to save by cutting expenses pales in comparison to the amount that you could be making if you were to actually focus on, delivering more goods and services to your patients, right? So, what are you going to actually save? You'll save maybe $1,000 here and $1,000 there. And if it's a waste, obviously I say cut that expense absolutely immediately. But you're better off focusing on how to become more productive while you're cutting these expenses. So we've got these last two I covered. We got two more. We have this one. Income is never regulated in a usual organization by desires for a surplus. So again, how am I going to sell? My overhead's 100. I want to do 120. So as far as the team's concerned, our goal is 120. That's what it costs to pay the bills here. But let's say I tried to sell them on, look, my overhead's 100, but I want to do 120 because then I have a surplus. That's not going to make 120. Not going to work. All right, then we have our last one here. To achieve a surplus, and he just lays it out here. To achieve a surplus, it must be masked as a quote-unquote necessary expenditure. So this tells you right there. What am I pushing the group to do? I'm pushing the group to do 120 because that's what we need to pay our bills. Do I need 120? No. You could go, well, gee, Jeff, you're being disingenuous. No, I'm just following the rules of managing a group. Is it better for the group if we do 120? Of course it is. Is it better for the practice? Yeah, we're delivering more stuff to our patients. We're helping more people. There's nothing wrong with that. It's all good, right? But is it better for everybody? Sure, then the practice can actually pay its bills and pay off debt, and I can give people raises, and I can buy new equipment. It's better for everybody if we do 120. But as far as everybody is concerned, that's what we need to make. We need to make at least 120. It's masked as Mr. Hubbard says, as a quote-unquote necessary expenditure. And then let's play this forward for a second. Let's say I wanted to do incentive plans, right? I want to do a bonus plan for the team. Well, where would the bonus plan start? If my overhead's 100, but I've told everybody we need to make 120, our bonuses start over 120. That's how that works, right? I'm not giving them an overhead sheet in my P&L. I'm telling them, look, this is how it works. This is what we need to make. You see? Now, let's say we do that and we're doing 120 now and I have a little bit of a surplus. How do I maintain that surplus? How do I actually keep it? How do I actually end up having something to show for it at the end of the month or year? Well, here's where it gets kind of interesting. What do most people do? They let it accumulate in their checking account, right? They just let it sit in the account, sit in the account, sit in the account. The messed up thing with that is you eventually spend it. And I've seen people get really crafty with this. I remember one of the first times I taught this information to somebody, it was one of the first finance courses. I had an office manager who was running the practice finances come up to me and tell me, well, we leave everything in one account and we just earmark this portion as the part that we've saved and we're not going to spend. I go, well, I wouldn't do that. She comes back to me the next month, they spent it. Why is this? Well, here's what Mr. Hubbard says. And this I've applied in so many different ways. He says a group poorly supervised, as in a government, will usually try to spend more than it makes. Okay, we've kind of established that now. Heavy supervision and economy can prevent this. Heavy supervision and economy can prevent this. And then here's the line you want to burn in your brain. Only the physical removal of money can achieve a surplus. I'm going to read that again. Only the physical removal of money can achieve a surplus. So what does that mean? So I've made 120. My overhead was 100. I have 20,000 left over. Maybe I'm going to leave some in the practice, but I want to save some of that money. Let's say I decide to save $15,000 of that money. What do I do with that? Do I just leave it in the checking account? No. I physically remove that money in cash. No, I'm kidding. No, I physically remove that money and I put it in another account that's earmarked for savings of some kind. Doesn't have to be a savings account. It could be another checking account. This is one of the things, like I told you, there's a lot to know about this. Part of how you manage your money is the accounting system. And we'll have clients with a reserve account, which is kind of a practice reserve or savings. And they'll have a profit account, which is where excess profit gets kicked over. So they're saving money for a real rainy day. Like we've had this bailed clients out numerous times, like during COVID. Or one client whose office burned down, he found out he had like $100,000 or $200,000 deductible or something crazy, but he had the cash, right? That's what reserves are for. But the idea is you at least have an account where you shuttle this excess money off to. Now, I've had people come to me and go, well, should I have it in a different bank? Should it be a money market account? Look, these are all accountant questions as far as, what type of an account it should be. Because the truth is and again, I'm not an accountant, I'm not a tax lawyer. I'm not giving you accounting advice. That goes with your accountant. But most practices, any excess or profit is going to be considered pass-through income anyway. You're going to pay taxes on it. Fine. See, I'm not going to not make money because I have to pay taxes on it. I'll just pay the taxes on it. So if I collect up an extra $300,000 by the end of the year in my reserve account, I'll just pay the taxes on it or convert it into, maybe put it into a high interest bearing account or invest it or whatever. That's what financial advisors and accountants are for. But the bottom line is I have the surplus. What you do with the surplus is up to you, right? You might use it to put a down payment on a building. You might use it to pay something off, pay off your debt. Up to you. And use your accountant for this to make sure you're allocating it in an intelligent way. But the point being is I would move it to another account. Now, do I have to put it in another bank? Do I have to, no, just start another account that your practice account is in. I mean, there's things like FDIC insurance. You want to make sure that you don't have so much in there that it's not insured and all that kind of jazz. But generally, you just move it. This goes back to like a discipline point. And the reason people will ask me this is they're afraid they're going to spend it. Here's the secret. Guess what? I'm going to tell you just here. Listen closely. Don't spend it. That's how you handle it. I've seen it where, who was it? I think it was that financial person, Susie Orman, years back, where somebody had this idea of, if you don't want to use your credit cards, either cut them up or you put them in like the freezer in a bowl of water or something crazy like that. In other words, make it hard to use them. No, just don't use them. That's the easier way to do it. If you don't want to use it and it really isn't a smart move, don't do it. You have to exercise some self-discipline here or you're going to be in trouble. But the most important thing to get from this is if I'm going to have excess money left over, I move it to another account so it's clearly earmarked as not spendable money. Then I'm going to start to accumulate a surplus. If I leave it in my primary spending accounts, 9 times out of 10, you're going to spend it because then you can't clearly differentiate between what's operational funds and what's excess money. Maybe one day you are in desperate need of cash and you have to, plumb your reserves to use it, fine, not ideal, but at least you know, okay, that's reserves. That's not part of my operating funds. And you could apply this information at home. Let's say you're married, and ideally, when you're married, one of the people in the marriage, husband, wife, I don't really care which, whoever's better with this, should handle the money. And you want whoever's handling the money to be somebody who's good at watching the money and keeping track of it and stuff like this. Does that mean they should keep the other person in the dark about the family's money? No, absolutely not. Not to get weird, but let's say you've got a married couple and one person's in charge of handling the finances and setting budgets and setting aside reserves and doing investments and things like this. Well, once a month or once a quarter, the two of you should sit down. You almost have like a family board meeting, and you can kind of show the other person, okay, here's where we are at. Here's what we have in savings. This is what we got here. This is what we accumulated there. It's kind of cool. You're showing them what you've got and where things are going. Because you do stuff like this, if one person's primarily responsible, let's say for the kids, they brief the other person on what's happening with the kids, if there's the ins and outs of PTA meetings and things like this. But doesn't mean that the other person should be kept in the dark, but one person ideally, not both, otherwise you're going to end up with a lot of finger pointing, is responsible for managing that. But you can apply this same thing at home. If you have excess at home, move it or you're going to spend it. Because as he said here, let's read it again. I want to burn in your brain. Only the physical removal of money can achieve a surplus. And, you could look at this stuff and you could go, well, gee, Jeff, this is really simple. And this assumes I have a surplus, which again is a whole other thing, which we talked about earlier, right? But assuming that you do, and you do this, I would say try it. And I would bet you would be surprised, very pleasantly surprised, because what you'll find after you've accumulated for a little bit and you're not spending that money is you actually have something to show for all the work you're putting in. You could try it at the office and you could try it at home. Anyway, shorter episode, but I wanted to throw that out there. It's just one basic datum that people don't think with, especially when managing an organization or a group. I do hope that it helps. I have those links on the episode webpage that I mentioned earlier in the episode, DDS Success, the MGE Power Program, and that overhead sheet, which you should definitely take a look at. If you don't have a complete overhead sheet, something very, very smart to do as soon as possible. If you want to know more about MGE, you can find us online at mgeonline.com or call us at 800-640-1140. Folks, have a great week, and we'll see you the next episode.